Good day, everyone. Today we will be discussing the topic of transfer pricing, audit, and dispute resolution. Transfer pricing audits are an essential tool used by tax authorities to ensure that multinational enterprises adhere to the arm's length principle when conducting transactions with related parties. In addition, transfer pricing audits help to prevent base erosion and profit shifting (BEPS) and safeguard the tax base of jurisdictions. So we'll be looking at Module 8, Transfer Pricing Audit and Dispute Resolution. And this will cover the transfer pricing audit process, risk assessment and profiling, dispute resolution mechanism, including administrative reviews and mutual agreement procedures. And we will also look at case studies, to use to illustrate some certain points. So now let's start. Transfer pricing audits are examinations conducted by tax authorities to ensure that the prices charged in intercompany transactions comply with the arm's length principle. These audits help prevent tax avoidance practices that could erode a jurisdiction tax base. So it is important that companies comply with arm's length principle. So what are the purpose or what are the objectives? One is to ensure compliance with local and international transfer pricing regulations, prevent base erosion and profit shifting, and protect the tax revenue of a jurisdiction. Now, before we move on to the audit process and procedure, let me just say something about risk assessment. Tax authorities rely on data analytics, system-based methods, and routine checks to identify high-risk taxpayer for TP audits. They typically select cases based on specific risk indicators or profiling. And some of these key indicators of transfer pricing risk is, when you have the low tax jurisdictions, transactions with related entities in countries with low effective tax rates may signal profit shifting. So when they see that, there are some related party transaction in low tax jurisdiction, this could indicate a high transfer pricing risk. Then centralized supply chains, companies that centralize procurement in low tax jurisdiction too may face heightened scrutiny. Aggressive tax rules, transactions with entities in jurisdiction with strict TP rules attract attention. Consistent losses, continuous losses, especially when the rest of the group is profitable, may indicate improper transfer pricing. Large volumes of related party transactions too can trigger transfer pricing audits. So companies with a significant proportion of intercompany transactions raise red flags. Then excessive intragroup payments, payment for services, royalties, or interest within the group need close inspection. Then lack of TP documentation or even inadequate or missing documentation significantly increases audit risk. Then sources of information for TP risk assessment. There are some sources like the taxpayers' returns and previous audit records can be like a source. Publicly available information too, including websites and articles, news articles, on-site visits and interviews with company personnel, customs and trade data too, the country-by-country reporting from other jurisdictions, the exchange of information under tax treaties could also be one of the sources of information for TP risk assessment. So now let us move on to the audit process and procedure. So let's break down the key stages of a typical TP audit. Now we'll look at notification. Tax authorities notify the taxpayer of the upcoming transfer pricing audit, stating the scope and timeline. And the tax authority, such as the Federal Inland Revenue, will first of all send a formal request for financial and non-financial information, including trial balances, ledgers, intercompany agreements, and tax computation. So that's the information request. Review and analysis. The tax authority reviews the submitted documentation, conducts functional and capability analysis, and evaluate the appropriateness of the transfer pricing model that is applied. So the FRS may ask that they make a presentation about their business model, operational structure, and transfer pricing policies to understand the context of related party transaction. Then field audits. For industries like manufacturing or extraction, the FRS may visit production sites or administrative offices to inspect operations, validate asset usage, and observe business purposes. Then after that, they could also do preliminary findings. They can do preliminary findings. Key personnel are interviewed to explain intercompany transactions, asset use, and risk sharing. This information forms the basis for the audit finding. So then documentation review, just like I said, that the FRA review of documentation, including contracts, invoices, and intercompany agreements to determine whether the arm's length principle was applied. Additional documents may also be requested. So after the authorities have done preliminary findings highlighting any discrepancy or issues identified during the audit, response and discussions, the taxpayer has the opportunity to respond to the findings, provide additional information, and engage in discussion with the tax authorities. So after they have reviewed everything, all the documentation, intercompany agreement, to determine whether the arm's length principle was applied, additional document may be requested. And after that, the taxpayer also has the opportunity to respond to it. Then once they respond, then transfer pricing audit report. So after reviewing all the information, the FRS issues an audit report outlining its findings. If discrepancies are found, the FRS proposes TP adjustments, and the taxpayer is given a period to respond and provide additional evidence. Then a meeting between the taxpayer and the FRS is held to resolve outstanding issues. If both parties agree, the final TP adjustments are made and any additional tax liabilities are determined. And if the taxpayer disagrees with the findings, they may pursue dispute resolution through the tax appeal tribunal or the courts. And we will be looking at the dispute resolution. We will be looking at dispute resolution later. So when you are preparing for a transfer pricing audit, you need to maintain a comprehensive documentation, ensure that your transfer pricing documentation is complete, accurate, and up to date, including the master file, local file, CBCR report. Conduct internal review, regularly review and update your transfer pricing policies and practices to ensure compliance with current regulations. Yes, conduct internal review or conduct transfer pricing health check. Engage with your advisors. When you are preparing, consult with transfer pricing experts and legal advisors to prepare for potential audit and addressing complex issues. You also need to train your staff. Train the relevant personnel on transfer pricing regulations and audit procedures to ensure readiness and compliance. So what are the common issues now? The common issues with respect to transfer pricing audit: inadequate documentation. Most companies don't provide comprehensive and accurate documentation to support their transfer pricing practices. Incorrect methodology, use of inappropriate transfer pricing method that do not reflect the arm's length principle is an issue. Inconsistent application, inconsistent application of transfer pricing policies across different jurisdictions. The transfer pricing methodology is not consistent, across all jurisdictions. Then lack of economic adjustment, failure to make necessary economic adjustment to account for differences between controlled and uncontrolled transaction. So let's look at dispute resolution mechanism now, administrative reviews. So let me start with the definition. Administrative reviews allow the taxpayers to seek a higher level review of the audit findings within the tax authority. And the process is the taxpayer submits a formal request for a review, citing reasons for their disagreement with the audit findings. And a senior authority within the FRS conducts a thorough review of the findings and may request additional hearing or documentation. The reviewing authority either affirms, modifies, or reverses the original findings. Now, for these particular in their processes, there is submission, there is review, there is decision. And the reviewing authority issues a decision which may affirm, modify, or reverse the original audit findings, just like I mentioned. Now, the dispute resolution, this is the mutual agreement procedure. So mutual agreement procedure. The mutual agreement procedure is a formal process for resolving disputes between jurisdictions under a double taxation agreement. It prevents double taxation by allowing tax authorities to consult and agree on how to treat certain transactions. So the process is that the taxpayer submits a mutual agreement procedure to request to their competent authority outline the nature of the dispute and relevant double taxation agreement, DTA provisions. Now, the tax authorities from the involved jurisdiction consult with each other, exchange information, and negotiate a resolution. So after this consultation, the authorities agree on how to allocate income or resolve the issue to avoid double taxation. Now, with respect to litigation support in transfer pricing disputes, when disputes escalate to the courts, litigation support becomes essential, and this include expert witness testimony. Specialists provide testimony on TP method and comparability analysis to support the taxpayer's position. Then you also need a legal representation, which is lawyers represent the taxpayer in court, challenging the tax authority's findings. Documentation preparation. Extensive documentation is prepared and presented as evidence to substantiate the taxpayer's position. So let us look at some case study with respect to transfer pricing audit and administrative review. So now LMN Limited, a Nigerian based, a Nigerian multinational, undergoes a TP audit by the FRS. The audit reveals discrepancies in the transfer pricing of intercompany transaction with its subsidiary in Kenya. Now, the process, the FRS will first of all request documentation from them, that is notification and information request. The FRS requests documentation from them, from LMN Limited, who now provides the necessary records. Preliminary findings indicate issues with the transfer pricing methodology. Then LMN Limited will engage in discussions with the Federal Revenue Service and submit additional documentation to clarify the discrepancies. Now, the final audit report proposes TP adjustments, and LMN Limited requests an administrative review. So after reviewing the case, the FRS partially adjusts the findings, reducing the taxpayers' liability. So now, after this resulting in transfer pricing adjustments, administrative review, which will be request for review, LMND request for administrative review of the final assessment review process. A higher authority within FRS review the case and considers LMN Limited argument. So let's move now to case study 2. Case study 2, we have mutual agreement procedure to resolve cross-border disputes. So PQR Corporation, a Nigerian pharmaceutical company, faces a transfer pricing dispute resulting in double taxation due to conflicting tax assessment in Nigeria and in the UK. So PQR Corporation requests for mutual agreement procedure through competent authorities in both Nigeria and the UK. The tax authorities consult and exchange information eventually agreeing on the appropriate allocation of income. The issue is resolved without double taxation. The issue is resolved without double taxation. So now let's look at case study 3. XYZ Incorporated, a Nigerian technology company, faces a TP adjustment after an audit. Disagreeing with the findings, XYZ Incorporated takes the case to court. So process is legal and transfer pricing expert prepare comprehensive documentation to support XYZ Incorporated transfer pricing practices. Expert witnesses provide testimony on behalf of Incorporated INC. Then the court rules in favor of XYZ INC, overturning the FRS adjustment. So this is just a case study. Now, in conclusion, transfer pricing audits and dispute resolution mechanisms are vital for ensuring that multinational enterprises comply with the arm's length principle and for protecting tax revenue. By maintaining proper documentation, proactively engaging with tax authorities, and using available dispute resolution methods, businesses can effectively manage transfer pricing risk and avoid disputes. The case studies discussed highlight the importance of preparation, transparency, and expert support in achieving favorable outcomes. Thank you for your attention.